Good afternoon. Welcome to the i3 webinar co-hosted with PATRIZIA, where we will seek to understand alternative property and how it can contribute to resilient portfolios in a post-pandemic world. I'm Tech 10 with i3, and I'm pleased to have Dr. Madhi Mokrane join us today. Madhi is the Head of Investment Strategy and Research at PATRIZIA. Now, for those of you who do not or are not familiar with PATRIZIA, it's the largest European real estate manager with 47 euros assets under management across core, value-added and opportunistic sectors across the continent, as well as assets globally, including Japan. A bit about Madhi, he joined PATRIZIA early last year, in fact, in January of last year. I guess that's just before the whole pandemic outbreak. So certainly you've got interesting war stories to share with us. And he oversees PATRIZIA's investment strategies, research and performance analytics. He works closely with the CIO in crafting the PATRIZIA's house views. Previously, Madhi worked at LaSalle as a board member, where he led the European strategy and research team and served on LaSalle's debt and special situations, as well as private equity real estate investment committees. And into today's topic, so we're talking about future-proofing real estate portfolios with a focus on the role of alternative property. Now, we'll cover this session in three broad areas. Firstly, at the high level, at the macro level, you have the longer-term secular changes, as well as currently the pandemic. So, Madhi will elaborate on how these trends impact the real estate industry. Secondly, we'll do a deeper dive into defining what is alternative property vis-a-vis traditional property, as well as cover the US, as well as how these trends are starting to emerge in Europe as well. And last but not least, portfolio construction. Now, how do you build resilient portfolios? How and why do you incorporate alternative property into the broader portfolio? So in terms of format, Madhi has slides for about 15 minutes. For the rest of the 40 minutes, there'll be a Q&A. And on that, I'll really encourage you, the audience, to submit questions via the question box, and we'll endeavor to answer them in the course of the conversation. So this webinar is for educational purposes only and does not constitute financial advice. It is intended for wholesale and institutional investors only. Welcome again, Madhi. Now, Madhi, before we get into your slides, let's try to set the context. Now, unfortunately, we are all too familiar with the ongoing pandemic, but there are also the longer-term changes impacting the industry. Now, you have articulated three major direct and indirect impacts. Can you elaborate for us, Madhi?
Sure. Well, thank you, first of all, for having me. It's a real pleasure, and good afternoon, everyone. So, I think the first thing to note is, we've went into an unprecedented sort of recession, and what this has actually shown us is which sectors, which property types have resilience embedded in them, and which actually have been more exposed than others. And for example, those property types around the beds and sheds, the residential and the logistics, have proven to be very resilient. We've seen this across the board, across the different regions, and it's been quite spectacular. One way to measure this, of course, is rent collection. When we went through the rent collection within our own portfolios, we looked at the listed sector, etc. So that's the first sort of immediate, most visible, impact, and that also, edges into the resilience of cities and resilience of states and systems. The other sort of impact that we've seen manifest itself is really accelerations of trends. Think of e-commerce, think of online sales, mobile-driven sales. Think of that drive, the drive for the tech infrastructure. These are all trends that we had been seeing, observing, monitoring, and trying to fit into our portfolios, but they've been completely accelerated, as well as everything around healthcare, impact investing. So acceleration of trends, recession, and resilience. And then the third one is around some of the beliefs that may be challenged. Think of urbanization. think of the role of property within a portfolio, think of traditional, positioning of portfolio construction. And that's really one of the themes that we want to, I'd really love to elaborate on today, particularly the emergence of so-called niche property types or alternative property types. And they actually, have an impulse response with respect to the economy, which are different from the traditional property types. And here again, we're spending a lot of time with our clients thinking about how to build future-proof portfolios, both in the traditional sectors, think of offices and the future of work, as well as, the role of alternative property types, think of, data centers, cell towers, healthcare assets, et cetera, and how that fits into, portfolio construction.
Thank you, Marty. I think there's certainly a lot to unpack, that transition from traditional to alternative, and that movement and how you blend everything together. But before we get into the portfolio construction, which I believe that's the crux of what we're trying to do as investors, I'm going to pass the time to you now to just do the deeper dive and define, what's alternative versus traditional, and obviously your views in what's happening in the US and how it's translating to the European landscape. So over to you, Marty, now for the presentation before we reconvene for the Q&A.
Thank you very much. So just to set the scene in a few seconds, what we've done here is we've looked at some of the trends that are common between the United States market, the Americas, Europe, and Asia Pacific. And traditionally, if you're a real estate sort of professional, you do see that some of the trends actually pick up quite early in the United States. And then one of the questions you have to ask yourself is, how is that going to pan out in other markets and in Europe in particular? So let's just start with the next page, which shows you the stock of assets, really the assets that have been invested in the United States. And what we've done here, we've blended both the traditional sort of directly held assets as well as those assets held by REITs, the listed sector. So this is more or less the composition of the stock of invested assets directly held, both in the listed and unlisted. And this is more or less the traditional. So, you could see the GFC, you see the kink in 2007 and 8 and 9, and then the bounce back, and then this long sort of period up until 2017, 2018. And broadly speaking, you see an upward trending sort of, but really rather smooth, growth in assets under management, driven by price appreciation and the creation of new product. Now, over the same time period, using the same data source, we looked at the niche property types, and that's depicted on the next page. And the story is very different. It's spectacular, particularly over the last 8 to 9 years. And this is really a fantastic growth of assets that we've seen, particularly since 2012-13. It's been driven by, as you can see here, healthcare, net lease gaming, data centers, and cell towers, as well as alternative residential and hotels. So really nothing much was happening before the GFC, and then this rapid acceleration of the products, and it's been mainly driven by the listed sector. But the spectacular thing here is that we're now at $1 trillion of assets under management, and the stock of those so-called, you can't call them niche property types anymore. They represent $1 trillion. This is a massive amount of stock of assets being held in different formats, in different funds and vehicles, and we can come back to that. But really, if you blend now to both the traditional and the alternative property types together, you get the visualization that we can see in terms of portfolio structure on the next page. So blending the 1.6 trillion plus the 1 trillion of alternatives, 1.6 of traditional, we put that together into sort of a portfolio composition of what the market is today. And clearly today, we have the alternative representing circa 43% of the invested stock in the US in 2020. This is a massive sort of percentage. This is something that you can't ignore. And when you construct a portfolio, and we'll come back to that later on, you have to think about the role and the place of these alternative property types in your portfolio targets and allocations. And clearly, the shrinking share of retail, the relatively declining share of offices, the growth in residential are things that are common between the US and Europe. We're seeing the same trends, we're seeing the same evolution, and you'll see that in Europe we're just at the very, very beginning of that story for the alternative property types. On the next page, Yeah, it's just taking a few seconds to pop up. So maybe I can elaborate. What we did is, okay, it's interesting to see those alternative property types, but what do they bring to the table in terms of returns, diversification, liquidity, et cetera? And what we did is we did a series of portfolio simulations, essentially saying the following, with a very basic rule: you go back 20 years ago and you focus on those pink cells, and you say, listen, what if I allocated 0.5% of my allocation every year towards those sectors that are popular, either generating excess returns, creating alpha, and let's see what happens in terms of my portfolio performance. And over a 20-year period, you could see that we're generating a 9.1% unleveraged return associated with 7.3% standard deviation, and hence the return per unit of risk taken, if you accept that standard deviation is the risk, is 1.25, as you can see on the top left of that table. And then what if I'm a faster adopter and actually I move 2% of my portfolio allocation every year to benefit from that emergence of alternative sectors? And I'm starting back in 2000 and then gradually pivoting my portfolio towards those more favorable property types. And here I move from 9.1 to 9.8% total return, which is a very substantial jump over a 20-year period. And the good news is I'm also decreasing the risk, the standard deviation. And if I'm an even faster adopter, so speed is critical here, then I jump from 9.1 to 10.8%. So these property types are return enhancing. They create alpha, as well as add to the diversification potential of the portfolio. And that's quite a statement, that's quite a result. And of course, the question is, which ones should we be going? How should we be thinking about creating this portfolio? As opposed to just this rule-based simulation that we did here. But it does convey the message that we're benefiting both from a return-enhancing sort of a optionality for investors today in the United States, as evidenced by this data series. And we claim that this is also going to happen in Europe, as well as the diversification potential. Speaking of diversification, on the next page, what we've done is we've looked at the structure of correlation across the different property types. So we took everything together, looked at the total returns, and the main result that you can see here is really depicted by the color codes. If you look at the color codes, you see that the traditional property types tend to be correlated one with another. You can see that on the top left, the traditional cluster. And then you have sort of 3 or 4 clusters that are emerging. You have a health cluster, in which we sort of bundled together senior housing, either net lease or operating nursing homes, medical offices, skilled nursing, and we've also added within that bucket the life science sort of assets. We could split them. We can debate whether it's an office or if it's a specialist healthcare cluster. We bundled it with the healthcare cluster. We've also seen the emergence of alternative living, in which we have the lodging sector. We have manufactured homes in the US, which is very specific. We have self-storage, which is linked to the dynamics of residential, and we have student housing. The net lease stands a little bit on its own, and unfortunately, we don't have data for the digital cluster to be able to have a structure of correlation, but we think that this is in itself a very important cluster in its own right. Think of cell towers, think of the data centers, and other sort of infrastructure linked to digital evolution. And we think that also has some sort of negative or really low correlation with the traditional sectors. So clearly, 4 clusters in this alternative sort of a universe are clearly emerging from the analysis that we've been doing using the US data. On the next page, we move to the question about, okay, how do we access these property types? And when we looked at the transactional information, and we're using RCA data here, that this is not the stock, this is the flow, this is the volumes traded across different years in the United States. And the striking feature here is that you see traditional, unsurprising patterns with the decrease in office share of transactions, the increase in industrial, quite spectacular, and the increase in residential. But you do not see the increase or significant share of the other bucket, which supposedly represents the alternative property types, which means that they have not featured predominantly in transactions so far. What that means, and we'll come back to that in a minute, is that you have to create the product, or you have to create the platforms, the operational and real estate platforms together to create the product, either through sale and leasebacks or through development or joint ventures and partnerships with operators in the alternative property types. You can't really buy your way into the liquid market, at least not today. In the future, probably, but not today, into these alternative property types. They have to be accumulated as opposed to traded in or out at the moment. And that's an important message. Now, let's pivot to Europe, and you'll see that we're now probably 5, 6, 10 years behind the US in terms of the market structure. So we're using MSCI data here, which represents the exposure of institutional investors in the UK, France, and Germany, just to take the 3 largest markets. So in terms of overall market size, these 3 markets represent 2/3 or more of the equivalent of the US market in terms of size of the market. And, portfolio compositions have changed over time. You can see this very clearly if you just take, for example, the UK. Initially, the main exposure or food groups in the UK, think of the early 2000s, was retail and office. And you can see over time how that has decreased over time to the benefit of industrial and residential. The other category, supposedly capturing, the alternative sectors, stands at sort of 14%. It has grown, but it's still quite minimal compared to the 43% that we've measured for the US. And it's even smaller if you take France or Germany on continental Europe. Portfolios have changed there as well. Slightly differently. If you take France, for example, the office sector is still quite predominant, quite large. And if you look at the industrial and residential sectors, they are growing quite significantly. But the other category is quite small. And Germany, story slightly different. We have a large proportion of residential that has grown, as well as industrial, to the detriment of retail, and to some extent office that are still quite predominantly represented in portfolios. But here again, the other category alternatives are really low in terms of representation. Now, maybe you could argue that you could access those products to the listed sector in Europe. And on the next page, what you see here, what you're looking at, is the EPRA NAREIT. And what we did is we collected the data and we looked through the data and the portfolio composition. And although compositions have changed, similar to what we've seen with institutional investors in Europe, the exposure to the alternative property types is still quite minimal. We have a high representation of residential, a lower representation of retail, and a relatively stable but declining, nevertheless, exposure to offices. But we're not seeing a massive increase in the exposure or the ability for investors to access tactically, alternative property types through the listed sector. And if you look at the transactional market in Europe, and that's on the following page, here again, it's exactly the same kind of story. So this is the flow of transactions. Really sharp decrease post the COVID-19 in terms of office transactions, increase in the relative share of residential, we call it apartment here, and industrial, stable, in terms of the other property types. But here again, the other category has stayed relatively small, but it is increasing. We are seeing, and we think this is just the beginning of the story. We've seen some large transactions in life science, in healthcare, and we're being very active at PATRIZIA, particularly in the living sectors, the alternative living sectors, to develop platforms to access these products. And the lessons we've learned are really sort of summarized before we go into the Q&A. And this is my last page. On the following page is one of the lessons we've learned from looking at the US experience, from doing our own experience here in Europe, is that blending operating platforms, blending OpCos and PropCos is often a way to access the product. It's key to unlocking alternatives. First of all, in many instances, if you look at the market structure, who owns those assets that have those tailwinds, that will drive performance and increase diversification potential? It's operators that do not really trade those assets in the market. So you need to blend your OpCo and PropCo, be creative in the structures to facilitate accessing these effectively accessing these property types. So being able to have some sort of element of control, either through JVs or very tailor-made structures, to be able to access the product. The second benefit of blending OpCos and PropCos together in a smart way is it enhances control. So as an investor, you're having your hands on the key operational parameters of the investment. You're taking control of some of the companies. You're taking your share of the value creation, and you're controlling the relationship in terms of the relationship between the OpCo and PropCo. So there's no dispute between who creates value in these instances. And last but not least, in terms of risk-adjusted returns, you're creating a product in which in the future you will be able to have the optionality to sell the whole as a platform or sell different parts of it, both the operational side on the one hand and the real estate, but you would have structured the cash flows and the leases and the relationship between the two in a very stable way. That stability would actually lead to what we think is a yield premium that then enhances the exit value. So these three benefits for us are the benefits of early movers into a market that is growing, that has strong megatrends into the different clusters that I mentioned earlier. And we believe this is probably a great way to create resilience within portfolios for the future. Tyke, this sort of concludes my sort of presentation for this morning, and we can gladly go into the Q&A and discussion.
Thank you very much, Marty. In fact, I'll say good morning to you and good afternoon to our audience. It's late evening here in Australia. You certainly covered a lot of grounds, and I think to your last point around OpCos and PropCos, I know the large superannuation funds in the audience will certainly be interested, given that propensity to want to co-own or to co-invest versus going to fund structure. But I might just park that one side for now. Now, to your audience, again, questions are open, so I'll encourage you to put in questions via the question box, and we'll address them as we go along. Marty, I might go back to the beginning in the sense you've done some comparisons between the American market, which is a lot more matured, and the European. I guess my question relates to the drivers of change. You've explained the drivers of change in the US. Are you able to compare and contrast the differences, US versus Europe? What are the main drivers behind the emergence of alternative property in these both jurisdictions?
Yeah, having had, of course, we have experience at PATRIZIA of investing in the US, mainly indirectly, but of course directly and indirectly in Europe. And what we've seen is that the drivers are more or less the same, but the market structure is different. The drivers really, you could put sort of three key ones, and highlight them. First of all, of course, demographic change, aging populations, urbanization, these, demographic, propensity to own versus lease, the way, the consumer behaves, the different, everything we learned about the millennials generation, Gen Z, etc. These trends are common, and that's one of the things that makes us think that, we will have the same drivers towards these market changes and evolution of the alternative property types. However, the market structure is different. We're in a much higher, high densely populated areas. The planning systems are different. For example, if you one of the key drivers you may have seen on one of the graphs of the alternative property types have been the cell towers, right? And these are huge, extremely high cell towers that have the ability to be leased by floors to different operators in the from 3G, 4G, 5G now, and they're very popular and very successful in the US. We see that growth being with a similar trend, but very different in Europe. You don't have the same authorization to get them up out of the ground and lease them in Europe because of planning restrictions, etc. So it'll have to be something different. But we believe that in each of those clusters, we'll have to choose and pick how these things will evolve. The other sort of difference is with respect to who owns which part of these operating real estate assets. In the US, a lot of it is actually owned by private institutions, private companies, and then there's a sort of a negotiation to get the sale and leaseback and the partnerships into action. And it's easier and quicker, and you can have a continental, pan-US strategy. Europe, again, given the market structure is different, the ownership is more fragmented, and the regulations and market structure is more fragmented. So in terms of, you have to be a bit more nimble, and have a strategy that can be adapted by, country by country. And that's what we're doing. For example, our healthcare, platform, we're developing it first in Germany, and then we're expanding it. Student housing, UK, and then expanding it. So we're taking different stances and adapting it to the market circumstances and market structure.
Yeah, I get a sense also, I guess Europe is a more of a fragmented market, whereas US is, generally speaking, a bit more homogeneous in a sense.
Yeah, I think it's true, although it has, in terms of the fragmentation was probably, on a scale of 1 to 10, much higher in the past, and it's opened up tremendously in Europe, but still, we're talking about a continent in the US, and we're talking about, it's a larger population in Europe, if you think about it. You have more sort of investable, sort of, very highly densely populated cities, and the stock of assets potentially that could be owned by institutions is bigger in terms of, population is 450 million. It's larger than the US is. You have more homes, you have more assets in general. It's just a way to access them, and the fragmentation and the ownership structure is a bit different. But we think that, by developing the right strategies, and looking at each of those opportunities in a different way and structuring the access, then I think you can reap the benefit of having these alternative property types play a favorable role in your portfolio.
Sure. I've got one more question on the trends before I'd like to jump into the portfolio construction, which is probably more important. You've talked about the speed of change, and I think in one of your slides, you talk about the speed there. You've also highlighted in a very interesting way how in the US, post the global financial crisis, 2011, 2012, there was that spike up, in the US market. Is this something that we would see in the European markets as well? It's like there's a point where there's a trigger that more would happen, or the speed? I mean, how do you translate that into the European market?
It's a great question. We've been thinking about that, and we've been intrigued by these changes. I think the conclusion we've come to is that if you look at in more detail into the numbers that I depicted, I think it was on slide 3, I think. You see that the first pickup is really around the tech cluster, around the, digital infrastructure, the cell towers. And this is really when the US, massively moved into, accelerated the move into the need to develop this infrastructure across the whole country in the United States. And where you saw a number of listed companies coming and emerge, a number of operators and managers emerge and really take the leap of faith into developing those cell towers, data centers, etc. And that has happened, but at a slower pace in Europe.
Sure.
And the other thing is that the ownership of these assets are still in the hands or in the balance sheets of operators and telecom companies, etc. And this is where I think, COVID-19 could accelerate that trend to move into, okay, is it the best use of my capital as a tech operator to still hold on to my data centers and to my assets? I know they're critical to my operations, but I can find a financial partner that would understand the business and partner with me to grow my portfolio, and it'll be a better use of my capital. And these are conversations we're continuously having with the operators to unlock these assets. And that's why, that was the number 1 criteria to blend the OpCos and PropCos, to be able to have that conversation in an informed way with operators. The conditions of the GFC that triggered that growth, I think, are different today. So that's why I think the speed in Europe is going to be slower, but the early mover advantage is still there. And we may have some property types, particularly in the living sectors, that will accelerate faster than others. I think the digital and living sectors are probably the two that have the potential to accelerate at a pretty high speed.
Sure. Moving to portfolio construction, this is more of, I guess, the point of clarification. I mean, in a couple of slides, and this relates to the US market, you had emphasized that alternatives represent more than 43% of the invested stock. This was in 2020. Whereas in a separate slide, you mentioned that alternatives have not figured predominantly in market transactions. Investment versus transactions. Can you clarify that?
Sure. I think so when I mentioned using the NCREIF and NAREIT indices and data, I was talking about the stock, i.e. what you have invested in portfolios, wherever that portfolio is. If it's a REIT portfolio, or if it's a pension fund, a life insurance company, a foreign investor in the US, etc. So that's the invested stock. And that today, if you take a snapshot, 43% of that, about $1 trillion, is alternative property types, and 1.6 trillion is traditional property types. So that's the market structure today. And then what we did is we looked at the transaction volume, the activity of trading in and around those assets. And this is where we found out, we saw that the traditional property types still represented 90% of the trading volume, whereas the alternatives featured very low in those trading volumes. Now it may just be a data glitch in terms of categorizing those assets, but still when we look at the mega transactions, they've been through M&As or platform building, etc. So the action is not in the traditional buy and sell properties in the alternatives today. It's not yet. It will come, and as those properties become mature, established, and people know how to underwrite them, and agents and investors and buyers and sellers are familiar and comfortable in pricing them, they'll become mainstream, right? They won't be niche anymore. And that's where I see the opportunity today in Europe. If you can build that future core, future mainstream today early enough, then you'll reap the benefit of two things: extra alpha and diversification.
Thank you. Yeah, I guess I'm just wondering whether that's, in a sense, lack of transactions, or we could do with more transactions, impact, in a sense, the availability and liquidity of investable assets for investors. And you might know, on the part of Australian investors, fees are, we're quite fee sensitive, whether that has a knock-on effect on fees for these sort of niche type assets as well.
I think it's a fair question. I think and that leads to sort of investment strategy. And as an investor, of course, you need to position yourself into saying, what do you want and what do you expect from a specific strategy. So if you're looking at and contemplating an alternative, property type, at a stage today in Europe where you're quite early, what you're positioning yourself for is really an OpCo, PropCo sort of kind of approach today. You don't have pre-existing funds that have specialized. Many of our core funds, for example, at PATRIZIA, core strategies or core programs, have embedded into their strategies growing exposure to these traditional alternative property types.
Right.
So you could get a partial exposure through a traditional sort of core offering, and that will help you get access to, say, 15, 20, 30% in the future exposure to these alternative property types, but in a way where you're not taking too much OpCo risk, operational risk. However, you could take a different standpoint and say, I want to be early here. I want to create the product, get hold of a mix of, OpCo and PropCo. There's a private equity element to it as well as a real estate element to it. And then I'll structure this, create the product, and reap and then you're contemplating a core plus value add kind of return. And hence the sort of the fee is different because you're structuring an investment that has a dual component to it, and the returns more than compensate for the potentially additional sort of, I would say not fee, it's more a cost element to it to underwrite both the OpCo and the PropCo.
Yep, there is a question from the audience, in fact, relating to OpCo and PropCo, so it's probably an option for me to raise that.
Sure.
So the question relates to, can you give an example of a transaction demonstrating the OpCo, PropCo value creation? Can you give an example?
Yeah, we've I can't talk about specific deals, but what we've looked at recently, at a couple. One of them was linked to a large student housing portfolio that traded about a year ago in Europe. And when we looked at the underwriting of the assets themselves and the comparison with the OpCo, PropCo, the effective transaction that was done, which was a blend of the two, we saw that there was about a 20 basis point premium attached to it. And this is with the help of our advisor. So that was quite a significant, and I think the reason for that was that the buyer was then seeing the OpCo as an accelerator of future growth, as well as what I highlighted earlier, which is a control element, because then you have an operator that will not necessarily go with your competitor to develop a new portfolio in a different city. You actually have some kind of element of control of the future destiny of your operations. And the third element, which is you're combining value here that stabilizes the cash flow. You're structuring the relationship. Often when we look at past sale and leaseback deals, for example, one of the reasons that some sale and leasebacks have failed is that by wanting to maximize the exit value, the operator put too much of an onus on the rent and positioned the rent that the operations were supposed to pay and the growth rates in the future, in such a way that it put some of the operations in jeopardy. By blending the two, I think you're taking some of that risk out because you're embedding the whole destiny of the deal. So that's one example, and we're working on a couple of transactions still in the student housing as well as the residential or quasi alternative residential space, and we're sort of contemplating similar sort of a premium that I mentioned.
Good. A couple of in fact interesting, very portfolio construction questions. I might preface the next one with there are certain funds in Australia that instead of having a real estate team, they have a real assets team that combine infrastructure and property. And in fact, I've had discussions where some would say, data centers, is this an infrastructure play or is it a property play or both? And this question is, should these niche sectors be accessed through property managers or infrastructure managers? Now, both asset classes seem to include these niche sectors as part of the opportunity set. So what types of managers are best suited to extract value from these sectors? Now, I know you're a property manager, so there's a bias there, but what's your view on property versus infrastructure?
I'll surprise you. I'll surprise you. And you did portray us as a real estate manager, but we are a real assets manager. And we have about 2 billion of our 47 into infrastructure. And this is a growing share, and this is one of our key strategic objectives to grow the alternatives. And for example, it's very interesting you mentioned data centers because we're looking at a number of transactions and opportunities in the market. As we speak today, for us it doesn't really make a difference. We're real assets managers. Anything that relates to what a built environment can build as a service towards the community. And of course, we're not talking about toll roads here. We're talking, if you think about the digital sort of infrastructure, think of the cell towers, think of the data centers. They're firmly in the ground of real assets, and they're bundled with real estate in the U.S. There's no reason that should be different in Europe. And I think as long as you can actually factor a lease attached to it, there is a arm's length negotiation between an operator, an owner. If you blend the two, then you can structure the things as you would like. We are a real assets manager, and we think a number of our peers have moved exactly into the same direction. I totally agree that some of the lines may be a bit blurred in some instances, but broadly speaking, we see opportunities, and when we can operate and we have the expertise and willingness and expertise to operate, and create the products in a smart way, there's no reason we should leave it because of a labeling reason.
Yeah, and again, the next question, which is a very important question, I think it relates to the transition, because most investors, as you expect, will have lots of exposure in the traditional sectors. Your retail, office, industrial, and I think lots of Australian investors also have lots of exposure locally. So this question is, from a portfolio construction standpoint, what can be done to make traditional property asset classes, more successful or resilient going forward, vis-a-vis the global trends that you have mentioned and discussed? What does a future quote-unquote successful office or retail look like, or if there's such a thing?
It's a great question, but I don't know that we have enough time to cover everything here because frankly, this is really at the heart of what we do in our house view. What we presented today, what we discussed today, is part of our house view. The bigger part and the wider, the complete part, really goes exactly to your question and the question from the audience. First of all, you have to look at your existing traditional exposure, and it starts with retail, because that's the critical sort of asset that has been challenged, and it has been challenged for some time. And sometimes you have to accept, selling, converting, taking part of the loss to, move on, because if you hold on to some assets for too long, some of these trends have been accelerated, as I said, by COVID, and some have actually proven to be resilient. Think of food anchored retail, for example. That's been a very resilient property types, and we've been very successful, and it's been quite rewarding. high street, shopping centers, discretionary retail, you have to really take a critical view, filter your assets, and take hard decisions. On the office sector, we've come to a conclusion such as things around future-proofing office portfolios and future of offices. We need flexibility. We need assets that are perfectly located, and we need to provision for bigger capex spending. And this is not just about the trends of co-working. This is about trends about ESG and health, well-being into in-office assets, and the requirements to keep them up to date and to cater for the future sort of regulations around ESG and energy consumption. So again, take a hard look, very critical look at your existing portfolios, action on these portfolios, move into the sort of successful beds and sheds, and think about what alternatives can do for your portfolio in terms of construction. And one of the benefits, I think, you don't have to aim at a dual objective of return and diversification. You can have one of the two, which is already quite a really good result. And we're talking to some of our investors about boosting their returns through alternatives. By some of our clients actually are thinking of exactly as I think you were saying, let's take the OpCo through our private equity business, and let's take the PropCo through our real estate business. And then they bring different sources of capital, different return requirements, and we can then move on. Others would take the holistic view within a blend and take this as a real assets approach, and let's move on. But you're absolutely right. The question starts, what's the resilience and future proof of my existing portfolio? What kind of decisions do I have to take? Some of them may be a bit harsh, and you need to accept that some of the value may have been eroded because of mega trends. But then you can always take those issues and now, buy insurance before you need it, and then move on to the alternative property types that can add and boost your returns and risk-adjusted returns.
Thank you, Madi. I think the whole area around portfolio construction is so important because it's about transitioning from the old to the new-ish in a sense. We sort of run out of time, but I've got a final burning question, which I guess I have to ask you this. I mean, we talk about alternative and the word niche is being used time and again. How long will this niche market remain niche? I mean, will it ever become mainstream, and when?
It's a great question. Let me just get back to the experience that we've had. Let me give you two answers. First of all, if you think about residential today in Europe, in a number of countries, it's called niche or emerging. Think of BTR in the UK. It's a very popular thing. However, 70 years ago, 80 years ago, residential was the main asset in property portfolios and pension funds in the UK. Same thing in Germany, same thing in France, same thing in Switzerland and the Netherlands. And then, of course, they started selling because they went into commercial property, and now they're rediscovering the merits of investing in residential. So you have the ebb and flow of what is called niche and what is called emerging. It's slightly different because today the product is new, whereas in the past it was existing assets that were built, post, different, historical events, including wars, when you have a reconstruction boom, and then you have institutions that come in. I believe that the digital infrastructure will become mainstream very quickly, if it's not already mainstream in the US. I think data centers are now very established, particularly when you have, 5 or 6, listed property companies that are highly researched, very transparent, and provide all the, the metrics that you may want to underwrite and be comfortable with the property type. It may take a bit longer in Europe, but again, going back to my point, I think alternative living assets as well as digital infrastructure are the two that are probably going to emerge more quickly. I think the healthcare and well-being is one that is also now following suit, very, very quickly after that.
Great. I think there's a lot more we cover in the portfolio construction, but look, on that note, this concludes our webinar session with PATRIZIA. I want to thank Madi for your generosity in sharing your research and your perspectives. And for our investor audience, I hope this has been meaningful and interesting. In fact, we recently did an editorial feature interviewing Madi on alternative property. This article is available on our website, which you can refer to. So for now, thank you. Stay safe. Hopefully see all of you in person very soon. Bye for now. Thank you.
Thank you very much. Thank you for having me. Bye.